My name is Larry Tabb. I am founder and CEO of Tabb Group, and we host Tabb Forum, which is a community blog. I want to thank the Milken Institute for inviting us up. We've got a really great discussion around bond market liquidity, and it's a trick of the trade, pouring liquidity back into the fixed income market. When we looked at the in the morning discussion about volatility, this whole issue was front and center. Really, the whole idea that financial regulation and the crisis has kind of changed the way that especially corporate bonds have traded, and because of the issuance issues, that there's a real issue out there. And with us to discuss this, we'll start from my far right, Constantinos Aniakos, I'm sure I messed that up, Global Head of Fixed Income at LiquidNet. Michael Freno, Head of High Yield Investments at Babson Capital Management. Amy Koch, Managing Director, Head of Fixed Income Trading at Standish. To my left, Fred Orlin, Head of Global Fixed Income at Jefferies. And last but not least, Commissioner Michael Piwar, at one of the 5 SEC chairmen at the Commission. Thanks, Commissioner. Couple little housekeeping things. One is that we're going to try and take email questions or questions by email. So my email address is up on the screen. So ltab@Tabb Group. It's pretty straightforward. Before we get into the discussion, let me go real quick through a couple of slides and just frame the discussion really quickly so people can understand, what the issues are. So if you bring up slide 1. Basically, since the crisis, interest rates have been low, and the amount of issuance and outstanding corporate bonds has really kind of done the hockey stick thing. Issuance has almost doubled in the last 13 years or so, and it just continues to go up. Slide 2, real quick. As you see, the dotted red line, that's our outstandings line. The dark blue and the multicolors on the bottom, the solid chart is really in terms of dealer inventories. Now that big height was a lot of CMBS, so it's not really completely relevant. But you've seen the deleveraging of the bank's impact on inventories. Our view from 2007 to 2014, dealer balance sheets are down probably about 21%. So it's pretty significant. But when you combine that with the issuance, it's a little scary. Put up slide 3. So here you wind up looking at assets in ETFs and mutual fund assets and dealer inventories, and you can see they're going in radically opposite directions. Slide 4. That said, the trading in the markets actually continues to move forward. It's just trading differently. We're starting to see a movement of the traditional away from the traditional principal positioning that dealers have traditionally done. I buy it, I hold it, and then sometime later I distribute it, to where there's actually more of a what they call riskless principal or an agency business where I don't really actually buy the bonds until I find the original person I'm going to sell them to. And I think with that, we'll get on to the discussion. So yeah, I think that's good. Actually, no, there's one. Yeah, that's good. So I guess let's get into the discussion. And so the question, I guess, is there's a lot of discussions as to, is this actually real? Is this challenge a challenge? Is this just a change in market structure? Are we really worried about how these bonds are going to trade in the future, or all of this kind of a bunch of hype? And I think to open this up, I want my 2 buy-side guys to really say, are you guys worried about this? Mike, let's start with you. Are you worried about some of these challenges and issues and change in market structure?
Yeah, I think right now we're watching it develop, and certainly there's potential for it to become a problem. I think anytime you change the behavior of one of the largest participants, and that being your traditional dealers, whether it's because they don't have the capital to do it or because their incentive structure works differently for them not to be taking risk, I think that always does change the dynamic. Coupled with the slides that you've shown recently, or just a minute ago on the size of the overall market and how it's changing, how quickly capital is moving in and out of these things. It's vastly different. I think we've seen a little bit of heightened volatility. You can look at the taper tantrum back in 2013 where you saw a lot of moves there. We saw it in the fourth quarter in more high yield assets of last year due to the energy concern about that. We haven't seen how these markets would react with the change in dynamics on a much broader scale, certainly like we saw in 2008, although I think the market structure is a little bit different than it was then as well, given it doesn't appear to be as much leverage in the system from that standpoint. But nonetheless, looking at mutual funds and ETFs at the volume that they have, they tend to be indiscriminate buyers and indiscriminate sellers. So you could have a similar impact to that to the extent that something changes investor sentiment. So yes, it is something I think is real and something that we're certainly cautious on.
Amy, your thought now in the morning, some of the things we're talking about really is, okay, you've got this, passive strategies that, when people start seeing red ink, they could sell, mutual funds. But on the other hand, you've got other investors who are going to be buyers, like pension funds and other, other players. Do you think this kind of balances out, or are you worried?
I think it's a real issue, but I'm not particularly concerned right now. I think especially when you look at corporates, it's such a diverse buying base. There's a lot of insurance companies, there's sovereign wealth funds, there's pensions endowments. Not everybody's a retail investor, and not everybody has to sell the second something goes down. So it is something that we pay attention to. I mean, we continue to see that slide on dealer inventories, but I don't believe that the dealers were made to be a shock absorber in the system. They're not supposed to provide the other side of every trade that we do. And if you look at trade volumes overall, they're up. We're trading more than we've ever traded. It might be different than we used to trade, but it's not to say that before was the perfect ideal scenario and what's happening now is wrong. Just different. And I think the buy side is adapting to it as much as we can. And I think there are some sectors are going to be more liquid than others, and I think the tail risk is what everybody's worried about. But overall, I don't think it's causing the buy side as much panic as we seem to read about in the papers.
Fred, we've got two kind of dealer, more traditional with Jefferies, and a little bit more electronic with Liquidnet. Fred, from a traditional standpoint, is this something that keeps you guys up at night? Is this an issue?
Well, no, look, I think the dealer community adapts to the reality that it has in front of it. And I think that people talk about all the different changes that have gone on and how all these things affect liquidity. I think that there are. I kind of look at it from two different perspectives. One, I do think one fundamental change that occurred was the DoddFrank rule,
right?
And more so than anything else. And the reason for that is. And DoddFrank sort of started the demise of the CDS market. And if you look at, in the slide, the 2002 to 2007 run-up in dealer inventories, that happened to run up with the creation of the CDS market and the tremendous amount of trading that went along with that. So the demise of CDS, obviously it is important. It sort of reduced the dealer's abilities to hedge. But also remember, CDS was a very profitable vehicle for dealers. And that was important. And the other thing is that as a result of the huge liquidity that was around in CDS, you had all these other hedge funds that developed strategies around it. So there was cap arb strategies, there was basis strategies, there was curve trade strategies, and all those strategies presented the dealer community with what I would call an uncorrelated bid. Meaning, if the big funds wanted to sell, these guys could be on the other side, not because they thought it was rich or cheap, just because it worked within their model.
Or they could hedge it out or do something.
It had to do with something completely different. It was uncorrelated. Right. So it was great. It created a lot of liquidity. The other thing that Dodd-Frank did was it caused the dismantling of the dealer-owned hedge funds. And we just it was almost like every week in 2006 and 2007 there was another dealer hedge fund popping up. And a lot of those hedge funds employed a lot of these same strategies. So they were a huge provider of liquidity to the street. So I would say that Dodd-Frank, more than anything else,
more than like Basel and capital.
Even more than Basel. I'll get to the other point I would make, and I promise not to talk this long in every question. But the dealers will do what makes sense and how they can make money. That's what they're going to do. And when Basel III came out, they didn't say, okay, high yield guys, you should reduce your balance sheet. It never said that. What it did do is it raised the amount of capital that the banks had to hold in order to do this.
So your cost of financing
went up. Well,
your cost of funding went
the
up.
hurdle rate, the hurdle rate on the return that you need to generate on trading became a lot higher. So all of a sudden dealers said, wait a minute, I can't get a return on certain types of risk taking on certain types of products, so I'll just go and be an agency and have an infinite return on my capital on those trades. So I think that so if we can figure out a way to get profitability back into risk taking, I think the dealers will do more of it.
Interesting. Now, Constantinos, how does that, that kind of plays a little bit into what you're trying to do at LiquidNet. Why don't you talk a second about that, and then talk about how you're, how these are kind of impacting you guys.
Of course. As Amy and Fred have just mentioned, there are some natural constraints today in the amount of liquidity that the dealers can provide. So then the question that we need to be asking ourselves as market participants is the current marketplace the best it can be, or can it be better? In the conversations that we have with our clients, I think it's very obvious that they think that there can be an improvement. And I think the improvement could come from unblocking the liquidity pipes. And wouldn't it be better if we have a system that combines what we have today with the dealers doing everything they can within certain constraints with something that also offers additional avenues by which liquidity could be exchanged? And this is where electronic platforms come into play, to add something which doesn't exist today and can add value to trades that could not be executed before. I think it's fair to say that most institutional investors would rather execute a trade with the dealer if the liquidity is available on the spot, immediate liquidity. But reality is, given how much bigger the trading needs of the buy side are today, there has to be a component of trading that can be best facilitated by bringing together the natural buyers and sellers of liquidity, whether it's just buy side or also with sell side. And that's where, again, electronic trading could actually help provide this extra liquidity that is needed today, and it will be needed even more in times of stress. I was a trader for 15 years, and one of the things I've seen is that at times of stress, the instructions from risk management are pretty clear. Don't take any more risk. Now, that makes your ability to act as an efficient market maker poor. So you need these other avenues to make sure that whenever there is a natural buyer and a natural seller, they can be put together in an efficient way.
So one of the things...
Can I just say?
Yeah.
I don't think I've ever told traders to not take more risk. Ever. What I tell them is find the level that clears it. Find the right level. But that's not the same thing as don't take any more risk.
But surely whether it's DoddFrank or all the other issues that have been mentioned must have had some sort of impact on your ability, whether it's from a risk standpoint or a capital standpoint, to take, let's say, the additional risk.
I actually, again, what I said in my answer, I think it's not a function of Dodd-Frank. Look, I've worked at a big bank, I've worked at a smaller bank. It's a function of, can we make money? Can we drive a return for our shareholders? Can we get a return on capital?
Which is, I think we're talking about the same thing in the sense that a number of trades that maybe 6-7 years ago would have been profitable, now they may not be. As a result, let's make sure that that buyer and that seller that could be on the two sides of the trade find each other in a different way.
Now, Fred, do you think that do you think this is, do you think this is more, Dodd-Frank regulatory driven, or is this more, flat low yield curve driven? So do you think if all of a sudden, we get a normal yield curve and interest rates start backing up a little bit more, that capital refreshes in the balance sheets, or do you think that, or do you think that?
Well, I think the yield curve does a couple of things, right? One is it's attracted a huge amount of money into the market, right? Which is a big problem for a lot of the money managers out there, and you can certainly ask our panelists. But so that creates a lot more money than there is opportunities to invest in. But from a dealer perspective, and the other thing it does also, it creates a huge amount of new issue, right?
Right.
In times of easier
Low
markets and low
interest
interest rates, you're going to get a lot more issuance.
Printing press is going.
But I mean, I think the dealers, we're going to try to match buyers and sellers no matter what the interest rate environment is.
Mm-hmm. So Constantinos was talking about really trying to, get, buyer, the buy side to trade with the buy side. Part and parcel of that is pricing, and I'm going to bring the commissioner in on this. And a lot of the discussion, I think, around during the financial crisis was transparency. Transparency is the best of all things.
Right.
I don't know, Trace is now, got to be 15, 17 years old.
2002, 2004,
yeah.
it was phased in. Yep.
Actually, today, there was an article in the FT that they want to try to push back the timing on trace. So how does transparency fit into this? And is transparency a good thing, a bad thing? Could this make it better? Could it make it worse?
Sure. Thanks, Larry. The first thing I need to do is just make sure to do my standard disclaimer, say any views I express are my own and do not necessarily reflect the views of anyone else at the Commission. In fact, oftentimes in these discussions, do not reflect the views of other people at the Commission. So we'll see what we get into here. You brought up trace, right? So trace was phased in 2002, roughly 2005 time frame. And what it did was, for those of you not familiar with it, it provided for the first time post-trade price transparency to the market. So prior to trace, if someone did a trade with a dealer, no one else knew what that price was traded at. And what trace did was added what's called post-trade transparency, which means that dealers now have to report to this FINRA trace system within, I think it's down to 15 minutes now, of the trade, and then that trade becomes transparent to the market. And as Larry mentioned, there's obvious benefits to transparency. It gives folks the ability to find out what the last trade was, where the market is on either that security or similar securities. But then other people have concerns about the fact that if you add too much transparency to the market, then the market will try to find other dark places to move, and then you get sort of the detrimental effects from that transparency. And for a few years after the trace was initiated, I would hear from the dealer community that, oh, trace transparency ruined the bond market. And I get very defensive about that, or very upset about that, because at the time that trace was initiated, I was working at the Commission as a staff member in the economics shop, and we did a research paper. There were 3 academic articles, empirical research articles, that were published in top journals, and I wrote one of them with my co-author Larry Harris and Amy Edwards, where we looked at the impact of trace on liquidity in the bond market and found that, in fact, it did not have a detrimental effect to liquidity. And in fact, what we found was that it actually improved liquidity for retail investors. The biggest improvements were for sort of the larger retail size, which we attributed to the more sophisticated retail investors, or retail investors who had investment advisors who were well aware of trace, but certainly didn't find anything detrimental to the liquidity. If you look at sort of long-term trends, as you showed, after the advent of trace, or around that time period, bond trading actually went down over that time period. But correlation doesn't mean causality, and other people have started attributing, well, potentially there were some other reasons for that, potentially the advent of the CDS market, which was already mentioned, and some other things. And so that's what we're trying to understand as regulators, as to how all of these things fit together. And I think you guys hit the nail on the head in terms of the 2 discussions right now. Why are dealer inventories down so low? Is it a more permanent thing like Basel Capital Standards or DoddFrank, or is it the low interest rate environment? And so that has impacts in terms of the way we think about what are the potential impacts of a liquidity event in the future. So if the Fed raises interest rates, are dealers going to continue to just sit on the sidelines because DoddFrank and the Basel Capital Standards? Or is it to the point now where they're going to actually be able to make money and they're going to start providing liquidity in the market at that point?
I don't know, Fred, in our pre-call, you had some pretty interesting things to say about transparency. What are your thoughts? Is this a good thing, a bad thing? Is pushing back on a little, or giving trace a little bit more time, or dealers a little more time before they publish the trace? Does that help, or how? And why and how?
Well, first of all, I have a disclaimer.
Okay.
And when I'm talking to an SEC commissioner, we just have to agree that I'm not going on any double secret probation list.
Yeah, that's right.
Okay, good. All right, so. Look, I mean, clearly, trace has had a salutary impact on aspects of the market. Clearly, retail, it makes sense. I think it has, when dealers are crossing bonds, it keeps them honest, which is certainly lowered transaction costs for the fund managers. But, as I was talking about, traders will will trade where they can get a good return. I think on let's say a less liquid bond, let's just give an example. If a bond's trading at 90 cents on the dollar, and Amy comes and says, hey, Fred, I need to get out of 15 of these, can you pay me, I'll sell them to you at 87. I won't do that, because if I buy them at 87, the 15 minutes later it goes up, it printed at 87. And I have nowhere to go with them. The most I can make is a quarter point, but I have unlimited downside. So that's just not a good return on capital trade, and traders won't do that. They'll say, yeah, you know what, I'll bid a couple and I'll work the order. So I think that if there were a delay, and we can base the delay either on issue size, you can base the delay on the amount of times that bond is traded over a certain period of time, So the post-trade transparency will be there, and the sort of keep the dealer honest will be there, but the dealer has, let's say, a month worth of time to get out of that trade, and if the dealer is able to make more than a quarter point, nobody will mind because the dealer took the risk. So I think that's one way in which to solve, some of the liquidity issue as it relates to less liquid bonds. So, I'm not listen. We're not saying it's not practical to say Trace is bad. We have to say how can we make Trace better.
But a month, 15 minutes to a month. That's
you'd have to scale it.
I know. I'm just giving you a little bit of grief.
Well, can I just offer some?
Listen, if I started out with a week, it'd be over. You'd be down to a day.
No, it's an empirical question as to what is sort of the optimal amount of transparency, and not only, do you make prices public, but when do you make those prices public and those sorts of things. And built into Trace, right, on the larger sizes, I believe it's 5 million plus for on the investment grade, or 1 million plus on high yield. You don't actually print the actual size. It just says 5 million plus or 1 million plus, and that's to sort of help anonymize the data and those types of things. And those are empirical questions that I think we need to have that are ongoing to try to find what is the optimal amount of transparency, right? Full amount of transparency all the time is not optimal. Zero transparency is not optimal, and we got to find the balance point in there that creates the most amount of liquidity in the market.
Amy, it's Amy and Mike in here. They've been a little quiet. I know that's probably my fault. But what's your thought on the transparency idea? More or less.
Well, I would say I agree with both sides. I'm in charge of the oversight, the best execution, and protecting our clients, and the pricing that the traders are receiving. So in that aspect, Trace is great, and it gives me all that information we need pre-trade, post-trade, and it helps the trader shape the markets on the liquid bonds. On the illiquid bonds, that information's not there. So I know exactly what Fred's talking about, because that does contribute to the illiquidity in certain positions. And it may just say, even though the print only says 1 million, there's a finite number of holders. There's a finite number of large holders in these positions, and it's easy to narrow down who it is and what they're sitting on and what your average bite size is. Now, a lot of the Trace data you see has to do with trades of 150K or 200,000 that you're seeing quoted, and that's not really what large money managers have to move. So Fred not taking down 10 million and taking 1 or 2 to work 8 means the price is going to drop, but taking 10 and not having it reported for a day or two, or having somebody else trade that bond and having us see it a day, 2 days, 3 days later, I'd rather have that price transparency after the fact. I don't need it at that immediate time, because we're not trading every single bond that we own every single day, and just because somebody else is trading it doesn't mean we're going to go out there and necessarily sell it. And I'm not sure that some of the bonds that we're actually talking about that would need the restricted time frame are really in the hands of retail investors. I understand the liquidity of a Verizon bond really protects them when they can see what the bid offer is on those securities, but it is a different story when you're talking about the tails of the market. And I don't think a one-size-fits-all works right now in high yield, but I think a couple of easy tweaks can really help the liquidity in the market for everybody.
Mike?
Not much to add on that. I think that's exactly right. It's when you come to high yield and smaller issuances, a $1 million print at some price is not really relevant to someone looking to move a block trade. And I think it does probably, in Fred's defense, discourage folks from taking that level of risk, because I do believe they're going to operate where they can make the most money, and having that price shown on Trace doesn't add anything really to us. We firmly believe that buyers and sellers will need to come together to find an efficient price, and we don't have to be a seller if someone's not a buyer. And when you get to the exceptions, as Amy's well articulated, that's where I really think it probably does start to fall down. Not that it can't be fixed with some tweaking and some changes to maybe size of issuances and things of that nature, but I can certainly see where the street has issues with it.
So maybe we do some sort of compromise where, depending upon activity or depending upon size or size and activity, there's a longer delay, and if it's like retail, then just put it up in 15 minutes or whatever, or something like that.
Yeah, I think so. I think that's probably the approach that you go, and it's going to look, some compromise is going to make probably everyone unhappy, but it would be a better solution than, again, having a $250 million tranche of a bond that you're looking to trade 15 on, and the last Trace print was $1 million. Is probably not a relevant stat to have anyways.
So let's bring Constantinos in here a second. So if you have a buy-side to buy-side platform, I assume that problem kind of goes away a little, or I guess with Amy and Mike, if you were trading together against each other, and I guess there might be a tail that might be issue. Would that play into your decision as well? I don't know. Or, I guess it's
Please.
Amy. Either any of you guys.
Well,
Amy, Mike?
from our standpoint, the trace print is good information, but that's not going to dictate what we're willing to pay or what we're willing to sell something at. I mean, again, from the institutional side and managing high yield, primarily we're going to assess what the right trade is at the right time. And so if there's a number up on trace, it's not going to change what we would actively do, I think, on the buy side.
Interesting. If you can put my email address up, I got one more question. While we go through the question, if you want to email me questions, that would be great. And I guess the last thing I want to do before I start opening it up to questions from email, because I got tons more questions, is ask. There's been a lot of discussion about Dodd-Frank. There's been some discussions about Basel. There's been issues with Commissioner Giancarlo trying to put out some proposals to kind of relax the CEF trading rules on the swap side. I guess the question becomes start with you, Commissioner, kind of off the record.
Just between us?
Just between us, exactly. Nobody watching on video at all.
Yeah, that's right.
Do we think we're going to get any? The Republicans have been trying to defund Obamacare like every single day for the last 3 years, and we have seen actually a couple of relaxed. They carved out some of the CEF, or they pushed back on some of the CEF pushouts. Do you think even if we get a change in political leadership in the White House, do you think we'll see some relief on the regulations on the rules?
On the legislative side or the regulation side? So I think on the regulatory side, first of all, right, you mentioned Commissioner Giancarlo at the CFTC. If you look at what we're doing in the OTC derivative space and in the swap space, the CFTC jumped very quickly out in front of the SEC, put a number of rules in place, and I think they're starting to realize that they may have moved too quickly in some cases. We are being much more deliberative and going a lot slower. Some people say we're going too slow. I've used the analogy of Aesop's fable, the tortoise and the hare. I really think that we're going to get to a robust set of rules in the derivatives market quicker than what the CFTC does. On the legislative front, it's been almost 5 years since Dodd-Frank was passed, and if you listen to what Chris Dodd and what Barney Frank were saying at the time, they said, of course we're going to have a technical corrections bill. We can't get everything perfect, right? And Dodd-Frank was 2,319 pages. And of course they didn't get everything perfect in Dodd-Frank, and of course Congress went and actually fixed it. Wait, no, they didn't. So it's been almost 5 years later, and there has been no technical corrections bill in Dodd-Frank. And you're right, the Republicans have been trying to push for that. Everything from just purely technical corrections, which is typos, commas, 2G when you meant 2H, all that sort of stuff, all the way up to repealing various parts of Dodd-Frank. I spent some time on the Hill, spent 4 years there, 4.5 years there. I've learned to never predict what's going to be able to get done on the Hill. But you're right, what we have seen, what has worked so far is there's been, by my count, 3 fixes to Dodd-Frank. One was the Collins Amendment for insurance companies that are designated by the FSOC, and then the other 2 are in the derivatives market, the swaps push-out provision and the end-user amendment for capital and margin. And the way that at least the last 2 got done was that they were provisions on must-pass bills. So I think that tends to be, I think that's going to be a strategy moving forward, is sort of pick the spots, pick rifle shots to Dodd-Frank that really, really matter, and then try to put them on must-pass bills and see if we can go that way. Whether there's a breakthrough, a log jam where we can find bipartisan support to do some of this stuff, I don't know. Talking to folks on the other side of the aisle, and full disclosure, I'm a Republican commissioner, folks on the Democratic side of the aisle, folks on the Hill, there seems to be some broad support for potentially some community bank relief in Dodd-Frank related. And then the question is, how far can you get from there? Traditionally, the banking committee before Dodd-Frank, if anything really gets done, it's going to be on a bipartisan basis, and so it's a question of whether or not they can work together on a bipartisan basis.
Constantine, you're talking to clients. What do you kind of see from their standpoint that they want some reform, or are they working in the current framework, or is this kind of a non-issue?
I would say that the response from clients tend to be mixed, but I think most importantly, our clients are looking at market-driven solutions, whether it's on the liquidity exchange or on the data side, to go on with their business. And I think One of the things that we're hearing pretty much from every client is that we acknowledge that there may be a liquidity issue, but we're also taking steps to make sure that we either change how we trade, or change our portfolios to make sure that when some of the issues do arise, we're not sitting ducks. And again, I think the key here is market-driven solutions, both on the liquidity exchange and also on the data side. And I think we've seen fantastic progress, especially the last year. Some of the new operators that are coming out with trading platforms, I think, are a very different strength and experience than 10 years ago. And I think on the data side, which goes hand in hand with the trades conversation, I think there are a number of independent third-party operators that currently provide very good data feeds. To some extent, you can probably have your cake and eat it too, in the sense that maybe you can relax potentially some of the requirements from trades, even though I don't necessarily advocate that, without making a big impact, let's say, on the pricing of less liquid securities.
Larry, can I comment on that real quick?
Absolutely.
So Constantine said market-driven solutions, and I could not agree more. So many people have been coming to us and say, well, the SEC needs to do something to fix the liquidity problem in the bond market, whatever it is. And just pick something in terms of help to change the market structure to force it in one direction or the other. I've talked to a number of folks that are offering a number of different potential solutions, whether it's buy-side to buy-side, established players in the market like Constantine, new startup companies that are coming with trying to come up with better mousetraps. And what I'd like to do is what I've been doing is say, look, let's just kind of see what works in this market. And as Amy said, maybe it's not one size fits all. Maybe one particular market-driven solution works well for high investment grade bonds, and one works well for the high yield debt, and one works for the municipal bond market, and we end up with a market that works well for everyone.
Fred, your thought on Reg Reform?
Well, I mean, Michael knows his stuff through and through, and you're just listening to him. He didn't say anything that surprised me, because the real sort of the economic issue is still there, right? The leverage ratio, the amount of capital you need to hold. Banks can have 13, 15% capital, so the same issue around the hurdle rate, the return that you need to get by trading bonds is still going to be there. Now, clearly, hopefully there will be some tweaks over time that actually get at some of the issues that could make it more favorable to trade for everybody. But I mean, in terms of, we're worried about, it's hard to say what the change will be if they change some of the things in DoddFrank. We haven't even had the Volcker rule implemented yet, not in any meaningful way. So, I mean, if they change a few things around it, that might be okay, but the market's already where it is without it being implemented.
We've got a question from Doug Frey, really talking about fixed income ETFs, and I'll pass it to Amy and Mike. Really looking at the performance of fixed income ETFs during stress times, and is this a concern to you guys? Is this going to be an issue, or do we think that there'll just be some sort of gap between market value and what these things trade at? I don't know.
Yeah, I mean, the ETFs are clearly a phenomenon that's new to our markets, and I think in high yield it may be more exacerbated than some of the more liquid fixed income sides of things. One of the aspects I think is favorable for ETFs in the bond world, if in the securities world, and this would be different from if you're looking at something on a leveraged loan capacity, is that they can distribute things in kind. I think that's a nice fail-safe mechanism that does prevent a complete collapse on things if there's no buyers from a cash side to take that on. So do I think it's going to increase volatility? Absolutely. I think if you look at periods of what has been somewhat little stress, they do diverge directly from maybe what the indices would be. Possibly they're in more liquid bonds by nature. They have to match their assets and their liabilities, so it does exacerbate that situation if you're holding those big large benchmark bonds. But I think those are structures that at least have a mechanism in place that will allow them to work through stress by being able to distribute bonds in kind.
Aim?
I'd say it's not my area of expertise, but you figure out which bonds are in it. You know which bonds are in the ETFs. You know exactly when they're buying and selling. It's the big, large benchmarks. I think it adds some transparency to the market. It's not really a surprise, and you kind of have to fit to a certain methodology for ratings, coupon, maturity. So a daily liquidity fund in the bond market is probably not the most ideal solution, but if you're talking about liquid bonds that are in it, then I think you're okay. I think if it's a lot easier than trying to invest bundles of cash all at once. When you get a new account coming in and you're getting, $500 million, you can't buy $500 million worth of paper at once. So you need a solution, and I think the market came up with one that seems to work. It gets us invested. It's an easy way to take on and off risk without using CDX, or it's just a replacement for CDX. But I think they're useful in their own right, but it's not what we particularly do. So,
Gotcha. Commissioner, are you guys worried about that?
We're worried about everything. We get paid by the American people to be worried about everything. So,
Well,
the question is, right? We have a fixed amount of hours in the day. So, how many hours do I allocate to this? And then we have a fixed amount, a number of people in this. I think we had sort of a natural experiment in this. We had a large, well-known fund manager leave, and billions of dollars went out of open-end funds and some ETFs. We saw that the market was actually able to handle that pretty well. I mean, we didn't hear of any sort of dislocations from that, and there was literally billions of dollars in a short period of time. And so we're looking at this from the perspective of what can we learn from different events that we have over time, and that was certainly one.
There was another question from Chris DeFrancis, specifically to you, Commissioner, really talking about settlement times. So can you ask the Commissioner what's the SEC thinking about the fact that there are open-end mutual funds, daily NAV, with hundreds of billions in syndicated leverage loans which have settlement times upwards of T plus 14, and that's just for U.S. loans. Is that another thing? You're worried about everything.
No, we're worried about settlement times are definitely something that's on our radar screen. I mean, even if you think equities have T plus 3 settlement times, and the rest of the world is moving to most of them T plus 1 at this point. Certainly something that's on our radar screen, and financial stability type issues. Some people have worried about certain potential systemic risk issues with fails to deliver and those types of things, and then also from an investor protection standpoint as well too. So definitely on our radar screen. Unfortunately, things like that, we only have so many front burners. I heard a joke recently that somebody says that the SEC invented a new stove. They have 50 front burners on it. And the reason for that is because there's so many issues that are hitting us right now. But unfortunately, because of DoddFrank, we are only 2/3 of the way done with our rulemaking on DoddFrank. It's been more than 4 years, almost 5 years since DoddFrank was passed. What that means is we have about 1/3 of our Dodd-Frank rules yet to get written. What that means is that we have this overhang in terms of the amount of resources that we have to dedicate towards writing the rules of Dodd-Frank. And then, oh, by the way, on the back end, you have to worry about compliance and all the other things as well too. And we can't get to what I call, our day job, things like, settlement time issues and trying to get in sync with the rest of the world, and just the well-functioning of the markets, the plumbing of the markets, those types of issues. I wish we would be able to spend more time on it, but just frankly, Dodd-Frank is killing us right now.
Interesting. So let's get back to some other issues. So it doesn't seem like we're going to see Dodd-Frank or Basel III go away anytime soon. We kind of have to plan for the market that we have. Interest rates are low, QE. Depending upon the poll this morning, not going to end to the end of the year or next year. So it looks like we're kind of in a status quo environment. What are you guys doing on the buy side on a day-to-day basis to kind of insulate you from some of this risk that we're seeing? Mike?
Yeah, I think we'll talk about all the opportunities that could happen in this space, and in the meanwhile, we on the buy side have to manage and prepare for something that happens. But I think, largely speaking, you look at the buy side shops that are out there, and they're looking at what are their liquidity terms that they provide for investors. A large part of the market, as Amy mentioned, is pensions, it's insurance companies, it's long-term investors that don't necessarily have that automatic redemption period where you're redeeming cash at the end of the day. So I think people are mindful of that. In addition, I think there's more and more talks of certainly looking at your liquidity lines that you have around funds, to the extent that you are managing a mutual fund that has daily liquidity. What are your liquidity lines? What do you have prepared to offset if something happens? And then you do a lot more analysis on the bonds themselves, and what is the liquidity of those bonds? How, if you can run through any sort of liquidity score matrix, what have you, but there are ways to look and see what you're holding there. And I think those are precautions. Cash is obviously a good one that hurts returns, so you've got to be mindful of how much cash you hold on that side. But absent that, I think the buy side is really limited in how many things they can do at this point in time, other than do their best to protect their investors.
Am?
Agreed. I'd say one thing that we're really looking into right now is our counterparty risk. We've spent a lot of time and a lot of energy taking a look at counterparties and stress testing that, and going through a mock counterparty default to see how we could operate, how we would handle it. Did everybody know their roles, how quickly it would take to get the information in and out and to restrike positions. I think collateral management is a really important part that we're taking a look at. I think analyzing the clearinghouses. We've moved our counterparty exposure away from dealers into clearinghouses, but have we created something new that could potentially be another shock to the system? So
Yes.
taking a look at that, but I think also within portfolios, you have to take a look at your liquidity. You have to focus on the traders and make sure that they have the relationships that they need to access the liquidity that we need when we need to trade. And I think we have to just make sure that we have a longer time horizon as, we are a buy-side asset manager, so we're not in and out of positions, but we have to understand what's liquid and what's not within portfolios and what our liquidity buffers are and where our concentration risk is and who our largest clients are and what our potential for withdrawals are. I think we've all taken a step back, and although we don't have a ton of new regulations on the horizon, I think there's a lot that we're doing that may not make the front page of the paper, but I think it's really reducing the risk and changing the mindset of how we operate on a daily basis.
One of the things that's kind of interesting that you didn't say, and I'll bring Constantinos in on this, is what about some of the new platforms that are out there? Constantinos, why don't you talk about a little bit about what you're doing, and then I guess the question that becomes is, are you? The next thing would be are you guys thinking about new platforms and distribution mechanisms? And not to, plug Constantinos or Liquidnet or whatever, but.
Of course. I guess on our side, what we've done is we spent a lot of time looking at what I consider to be some of the best practices from the equity space and see, okay, there's a market that has been operating electronically for a long time. It doesn't mean that every single piece of it is applicable and transportable to the fixed income market, but what can we pick and use it? That's one. Second, we talk to all our clients and figure out what is the magic recipe that actually makes something works. And like every other industry, there's probably a time that brings together let's say the right type of demand with the right type of operator and product to actually create something that makes a difference. And no different than the iPhone. Probably all the components of the iPhone were in place 10 years before it came out. But it took a certain operator under certain market environment, let's say, to put it together in a way that works. And this is what we're very focused on. And again, the guiding principle here is what our clients are telling us, such as passive liquidity, a dark pool that doesn't disclose their indications, and something that enables them to access the natural liquidity wherever it resides, whether it's from a buy-side firm or a sell-side firm. Last, something which I would say is a relatively new, let's say, dimension to this, and in the fixed income market it wasn't very dominant until recently, is the use of the order management systems. 5 years ago, nobody in fixed income talked about order management systems. There used to be effectively a risk management system and a trade booking system. Our clients right now are very tied into their order management systems. So one of the things that we're looking at is to make sure that we can maximize the liquidity that is sourced from our clients by directly connecting to their order management systems and enable them to effectively be part of the liquidity exchange mechanism with very little effort.
Let's go back to Mike and Amy, and then we'll bring Fred in here. What are your thoughts about some of the electronic platforms? It seemed like a couple of years ago there were a couple out there. Last year it seemed like there are a lot more out there. Is technology going to solve this issue, or is this kind of a thing that's going to naturally develop? Or what are your thoughts about how this develops with technology?
Well, I think technology and platforms such as this will be part of the solution in the long term. The two things that we look at are again, counterparty risk when you're going through something like that, as well as the anonymity. You want to make sure that that's certainly you're protected from that side. But I think they're in their infancy. I think they may have in years past been ahead of the technology that was available there. I think it's going to be part of the solution. Still do think when you're looking at things that are less liquid, the dealer community does a good job of sourcing an interest, whether it's a buy or a sell from that standpoint, that just can't be captured by posting something on an order book. So I think it'll still have its limitations, but it doesn't mean something like this, along with several other things, can't come to a compromise and come to some solution that works and covers a lot of the market and provides more liquidity in situations that may not have.
Mm-hmm. It's an electronic platform that provides a new pool of liquidity. Is definitely something that we'd be interested in seeing. We've seen a lot that take from one place and put it into another one. I think the platforms that we're reviewing now are more about pre-trade price transparency, setting this stage of the market and having something that you can actually print out to show your best execution, where it was traded, and any pre-trade information gathering right now. I think it exists in notebooks in people's heads, so getting a way to automate that is something that I'm very interested in. I think electronic trading will add to our execution venues, but I don't see it solving the liquidity crisis immediately. But buy side doesn't like change. Nobody's really good at it, so I think it'll take time to get it to be more mainstream, but I think it has to have a seamless transition with our OMSs, just like Constantine said.
Fred, to a certain extent, some of this technology enables you, some of it disintermediates you. Friend, foe, partner, how do you see it folding out? All the above?
Well, I think that there clearly is an application for electronic solutions. I mean, if you look at what market access has been able to do, they went from 5% of the market in 2009 to 15% today, and they've sort of gone after a segment of the marketplace that was ripe for that. It became a convenience help for the clients. At the same time, and I just happen to know 2011 was the last time I got the statistic, but there's 48,000 QSIPs, 22% of them traded 2 times or less. Yeah, so there's another whole segment of the market that I don't think an electronic solution is going to get at. But the one thing I would say is that for an electronic solution on a broader scale to work, all the parties that are involved have to be incented to be in it. So if
can't cut folks out.
Well, if the buy side doesn't really want it, it's not going to work. If the sell side doesn't really want it, they're going to go in there grudgingly. But it's not going to work. And that's probably why a lot of the ones that have happened already, the broader ones, haven't worked, because there has to be a protocol that everybody is going to be happy with.
Interesting. One of the questions from Steve Schenfeld was, please address whether liquidity is a bigger concern than asset liability mismatch.
Well, it's probably more of a buy-side question.
Yeah. Mm-hmm.
Well, if the question is, again,
he manages insurance money.
As I was talking about from the asset liability match of your assets being the collateral that's in your fund and the liabilities being your clients leaving, they go hand in hand, because liquidity probably doesn't change that much in the market, but just the need for liquidity changes. And depending on if you're not aligned and you don't have what I consider from the buy-side asset management standpoint of an asset liability match, then yeah, you can clearly do that. We talked about some things that have longer settlement periods. If you've got daily liquidity, or if you've got instantaneous liquidity like an ETF on something that doesn't settle, then you've got an inherent mismatch. So I think they go together. That at the times you tend to need the liquidity, it tends not to be there, if you want to look at it that way. But I think it's more the need for liquidity, and are you looking to sell, or are you looking to buy, more so than maybe the asset liability match.
Okay.
I think so much of the asset liability mismatch, it's kind of taken out of our hands at times, because you're defined by client guidelines that come in and tell you what you can buy, what your average rating is, what your maturity is, what your percentage in different sectors is. And so at that point, you've narrowed down to a portfolio that they're comfortable with the risk tolerance that's supposed to track the benchmark to a certain amount with a certain tracking error. So there's so many things that guide you to what you have to own at that point, that you have something that the client's happy with, that you're delivering the performance results on, versus daily liquidity, which is something that we really can't control.
Interesting. Let's get back to a little bit about the electronification of the market. Fred talked a little bit about market access, 15, 16% market share, mostly requests for quotes. You've got a liquid portion of the curve that folks are thinking about order books. There's, there were some session-based, basically call auction markets that were put out there. How do we think this is going to develop? Constantinos, I know you're kind of in a dark pool place. Is there going to be one protocol? Are there going to be multiple protocols? How are Amy and Michael going to address, are they going to know, like, how do I go here for this bond and here for that bond? And, this one's an auction that I got to show up at 2:53 p.m. or something on, how does that going to work?
Well, I think realistically, most asset managers are probably pretty busy throughout the day with their day job to actually start acting as what I call dashboard operators. But I think most likely each asset manager will find a small number, I don't know if it's 1, 2, or 3, of trading platforms that best work for the type of securities and type of trades they would like to do. I think in terms of the protocols, I think the market will actually prove who the winners and who the losers are. So again, market-based solution, let the operators go with their protocols and see what works best. What we're hearing from our clients is that what I call an active-based order book or a traditional auction that requires traditional asset managers to spend a lot of time monitoring the risk on these platforms is difficult. And we've seen it in our platforms in the past. So, when I mentioned earlier that we spoke to about 100 clients to come up with what I think is the right magic sauce, I would say the statement that probably resonates the most is we need to be part of the liquidity exchange mechanism by doing very little. And I think that points to a more passive liquidity order management system connected solution rather than, let's say, a traditional order book or an auction.
Bring the liquidity to my order management system. Let me interact with it that way. Fred, let's bring you in. What are some of the things that you guys are thinking when you're looking at these protocols and how to get involved electronically? Certainly, you're on market access, I assume.
Sure. Well, it was interesting. 3 years ago, 5 Boston-based accounts on the high-grade side invited 9 dealers to come up and talk about this problem. Mm-hmm. And they sort of tasked us with going back and sort of coming up with a solution. And I think there's a couple interesting takeaways for me. One was that what the clients wanted was they wanted the dealers involved. They wanted the dealers to be involved in whatever the solution was. The second one was they only had room for 2, maybe 3 platforms on their desktop at all. So to me, that just said, single dealer platforms are out. It's just not going to work. Right. So I think that was an important takeaway. So we went back and we basically came up with an electronic platform that kept the existing market structure. So dealers would flash click-to-trade liquidity to all the clients, and the clients could see all the dealers' pages, but the dealers couldn't see each other's page. So very much like the structure we currently have. And in addition to that, there would be RFQ functionality and also the ability to sort of do a quick IB to the trader and say, hey, I see you're the best bid out there. How big is your bid? So you could create a negotiation, if you will. So I think it made sense, and it made sense because the dealers were still doing what dealers do. They're incented to send out markets. Right. The other dealers can't see their markets, and the clients get, they benefit from technology in the sense they could click to trade, which is great. They could do all the other things they want all at their fingertips, but also it's just easy to line up and see where the market is. It's a little bit more of your sort of pre-trade transparency that you're talking about. So, the problem is, I shouldn't say, one of the things, the idea got sold over to TradeWeb, and it was supposed to be launched, and it didn't quite get off the ground. Now that I think they're recolonizing it, and they might try it again. But I think something like that makes sense because, again, all the players involved are incented to do it.
Yeah, but does it not need liquidity? Which I think it should be, in my view, the test for a successful, let's say, next generation platform. Does this
I think so. If you're saying, really, what you're saying is all-to-all, right? And when you get into all-to-all, to me, all-to-all works when there's resting liquidity, because that means, from a dealer's perspective, that it's almost like the equity market. There's a price out there, whether I like it or not. So I don't have to worry about giving away my price information because there's already a price out there. Then I'm really acting as a block specialist. So I think when you have all-to-all, I think the model you're talking about, if you have resting liquidity, the all-to-all model works, and the CDX is a great example of that. But where you don't have, resting liquidity, I don't think that works as well because the dealers aren't going to play.
One of the things with all-to-all is to a certain extent somebody has to come up with a price of, what do I actually want to deal at? That's traditionally been, the dealer side. And that's one of the big discussion points on, will these all-to-all, platforms work? Because, how are your guys' thoughts in terms of providing pricing and how you're going to do it? Certainly, you're not in the business of being a market maker, but how are you thinking about that?
Certainly not a market maker. I think that the hard part for us is the number of unique CUSIPs that are there in the market.
And the two bonds or the bond that trades twice a year
Exactly.
at best.
And if you need matchers, if you need a particular CUSIP, if you need a particular month, day, anything, it's really hard to work on a sessions-based electronic platform because it's not what you're looking for. The March 2018s are not the same as the Novi 2018s. And then adding in incremental line items is just not. It's not all substitutable. It could all be pari, but it's just not the CUSIP build that we're doing in order to consolidate line items. So I find it difficult, but we manage a lot of separately managed accounts. Each account is different. Not each one is trading together. If there's a name that we particularly like or dislike, then we're trading big blocks of it. But a lot of what we do is odd lots or 2 million and under or blocks of 5. You can't. It's really hard to go out there and see 2 million of a bond that's cheap and figure out across 600 accounts which one is going to be the one to get it. It's a lot easier when you're building positions to know what you want and to invest cash flows that way.
That sounds a lot like Richie Prager and BlackRock's paper on standardization. I think I think a lot of people think it's an ideal. Do you think it's practical? I don't know, Amy, Mike.
I think there's a lot of reasons why it would help. But I don't know how something like that gets off the ground in particular. Our insurance clients can't sell. We have gain loss restrictions. We have, but at the same time, if the top 10, or I think the stat was in the BlackRock paper that if there's the top 10 issuers in the investment grade in the Barclays index have 9,000 CUSIPs outstanding versus 10 equity tickers. It's not the same thing. You can't use what worked in one market and apply it to this market. So yes, I think some sort of standardization would be great. I just have no idea how you start and get there because it affects the sell side, the buy side, the clients, the issuers, everybody.
Mm-hmm. I'm going to hand it to Commissioner.
Yeah.
Is this something that the Commission would look at, or is this just really up to Verizon and whoever's issuing bonds?
So from my perspective, right? So BlackRock obviously has been in talking to us and other folks about this as well too. I think it's intriguing, right? Some people have suggested, well, you already have a standardization of this in the CDS market, right? You have, if you want standardized issues, you can do that. The question is whether or not it's going to work for the issuers as well too. I mean, it's we're here talking about the corporate bond market, but it's always been a puzzle to me how complex municipal bond offerings are.
That's
right?
even worse than
That's
corporate.
even worse. I mean, you have a serial offering of 30 different
something.
bonds, and you have each of the bonds have different provisions. Some have sinking funds, some have call provisions, some don't, and all those types of things. I mean, I think standardization it's an intriguing one. It's not going to solve the liquidity problems or the liquidity questions that people have today. Because even if you start today and everybody starts issuing standardized, you got a whole heck of a lot of non-standardized stuff out there. So maybe 5-10 years down the line, and so it's something that's in the conversation. There has been I've talked to a number of folks in the electronification one, and there's a lot of people think they have the best business model, and I want to see the competition go. I mean, you got Constantinos who's saying we're going to bring stuff in from the equity market and see what we can learn from this and stuff. On the far end of the spectrum, even ones that only trade 1-2 times a year, there are folks developing systems that say, look, those are more like a really illiquid residential housing market. And what do you have in a residential housing market? Well, you have someone who wants to sell a house, has a specific house to sell, but someone who wants to buy a house doesn't necessarily know exactly what house, they just know characteristics. And so can you set up a platform that allows those buyers and natural sellers to come together? Doesn't maybe necessarily add a lot of liquidity to the market, but it perhaps is something as a solution in that potential part of that part of the market.
Interesting. We've got about 2 minutes left. I'll take some hand-raised questions, or at least one maybe. We have a question out there? In the middle, there's a microphone coming if you can wait 2 seconds. Right, second row, middle.
Yeah, hi. This question's for Constantinos. If I think the advent of the electronic trading platforms address a lot of the issues which were discussed on the stage, bringing down from T plus 13, T plus 14, T plus 1 or 2. Sure. Just wanted to find out if you have standardized counterparty agreements in place, so that kind of counterparty risk is mitigated, and also what are transaction times typically on a platform like that?
Sure. The documentation for onboarding and counterparty risk is very standardized. So that's, I think, out of the way probably with most platforms. I think when it comes to, let's say, transaction times, it really varies. A liquid security would trade probably a lot quicker than one of those securities that trade once every couple of years. So it really, given the diversity of the corporate bond market, it is all over the place.
One more question? If you can identify yourself, that would be great.
Hi, it's Darcy Bradbury from D.E. Shaw. I was wondering if you have any observations about the October Treasury market flash crash.
It wasn't our market.
Yeah, I think most folks
No, I
on
think-
that panel are corporate guys, but
Yeah, no, I mean, so it's interesting, right? So you're referring to, for those of you who don't know, there was a liquidity event in the Treasury market on October 15th, and there may or may not have been, the futures market may or may not have been involved in that. My understanding is that the Fed and the CFTC are looking into that event. What was surprising to me was that from October to December, I had nobody come in and talk to me about it in my office. And then in December, I went over to Asia and visited 3 countries. And every single meeting I had with either market participants, government officials, or regulators, they brought up that liquidity event. And it really, really freaked them out in terms of, they deal in very liquid bond markets over there. And sometimes, this lack of liquidity, it hits them and they understand it. A lot of the global dealers are pulling back in certain ways. But when you have the most liquid bond market in the world have a liquidity event like that, and nobody until, even right now can explain what happened, it was really, really concerning to them. And so people are now starting to pay attention to it here and trying to figure out what happened. And it'll be interesting to see what comes up, whether it was in the cash market, whether it was in the futures market, what role potentially algorithmic players did to either exacerbate it or help mitigate it or whatever else, those types of things. So,
as a final comment, our panel's kind of over, but I want to say 3-4 years ago, when a lot of the HFT on the equity side was the rage, I got a call actually from the Treasury, who was very interested in electronic trading on the bond market. They're extremely worried. The Treasury Department's extremely worried about issues like that. And with that, I think we'll call it to a close. Constantinos from LiquidNet, Michael Freno from Babson, Amy Koch from Standish, Fred Orland from Jefferies, and Mr. Mike Pewar from the SEC. And thank you guys for joining us.